Hello, everyone. Welcome to this webinar brought to you by Bursa Malaysia and managed by our company LifeChamp. Today, our webinar title is When Precision Trading Meets Proper Portfolio Management. Good evening, everyone. My name is Shen Chu. I'm the moderator for this session. So today, we are going to talk about how do we combine precision trading and portfolio management. How do we use portfolio management, these strategy, these management skills into a position trading strategies? All right, so that's we are going to discover this. As usual, disclaimer: whatever we share in this session is only for educational purpose. So in no way that we give you any recommendation for you to buy or sell any listed securities that we mentioned here. So if you decide to make any investment decisions, you are 100% responsible for all your investment risk. All right, so allow me to briefly introduce our speaker today. And he is a position trading expert. Now, this is none other than Jeen Hao. Okay, now Jeen Hao is a position trader in the capital market focused on stocks and futures. He is the founder and the chief master trainer of Street Finance. His signature program is Street Trader Intensive Program, allows individuals to trade without monitoring and speculating. It is featured in media like City Plus FM, Borneo Post, Sinchu, etc. He often speaks for Bursa Malaysia and also other investment banks. He's also a frequent speaker in universities and colleges nationwide. So good to have you here, Jeen Hao.
Hello. Hi, Shane.
Hi, how are you?
Oh, great. I'm great.
All right, awesome.
Okay.
So without further ado, let me hand over the session to you.
Okay, so I would need to share my screen. Okay, just to double confirm, are you seeing my full screen?
Yes.
All right, cool. Okay, so let's just start with the content for today. Right, when position trading meets proper portfolio management. And this might sound like a very dull topic to a lot of people, but I'm glad that you are here tonight. Now, the reason is because a lot of people then neglect, portfolio management. If your portfolio suffers a lot, especially in this year, then one of the major reasons could be the way you are managing your portfolio, let alone your trades being, subpar or things along those lines. Sometimes great portfolio management can actually save you from, a lot of like disastrous uh, uh, trading outcome at the portfolio level. So today's topic, we're going to talk about position trading, which means when you are trading, you actually hold the positions more than a day, at least overnight. So it can be like a couple of days, can be a couple of weeks, or it can be, the entire trend. And the primary strategies that I use is actually called trend following. Okay, so it is one of the methods for position trading. And how can you couple position trading with portfolio management? So my name is Jeen Hao, and let's begin. Again, disclaimer as usual. Okay, so here are the content outline. First, what separates professional traders and amateur traders? Because like it or not, we need to know how professional traders think. At least you need to understand how they actually think when they are trading. Second, how professionals manage and handle risk. And third, how to manage your own portfolio like a fund manager. And fourth, how to position trade by following the trend. So if you are ready for the content, can you please type yes in the chat box? All right, type yes in the chat box. I think the chat is open for everyone. Okay, cool. Okay, so that's great because I need to know whether you are still with me. All right, so let's move on. So what separates professional traders and amateur traders? So what is this? This is iPhone. iPhone, don't know which generation. Now, I have a question to, all of you here. Okay, all of you here. If you are imagine that you are a, mobile phone shop and you have been solely selling Apple's product. So in this case, it could be just iPhone, right? Now, right now, the best-selling model is the iPhone 13 series. Okay, the iPhone 13 series. And iPhone 14 is about to, launch or what, okay? And you still have a lot of inventories for iPhone 12, for example. Now, my question to you is, knowing that iPhone 13 is about to come to an end and 14 is coming out, and right now 13 is still considered as the hot selling model. And the fact that you still have some inventories for iPhone 12 or even 11, my question to you is, are you going to sell off your iPhone 12 at maybe a slightly cheaper price or at your break-even price, or maybe at a little bit of loss, just to have more cash so that you can load up the hot selling model, which could be 13, or prepare for the upcoming 14? Would you do that? If you would do that, can you please type 1 in the chat box? If you wouldn't do that, can you please type 0 in the chat box? Right? So I see the chat box. It seems like there are more ones than zeros. Okay. So in other words, okay, most businessmen, they are willing to sell off all inventories or things that are no longer hot, okay, in order just to cash out. Okay, in order just to cash out, and then so that they have the cash to load up inventories that consists of stocks that are more popular, that could make them more profits. Okay, so this is generally business perspective. Okay, business perspective. So kind of like, I don't know, okay, you remember there is one time whereby there is one a toy that is very popular called the fidget. It is a fidget spinner. It's like a toy whereby you have like 3 holes and things like that, and you can spin it, and a lot of kids like that. Okay, and that during that period of time, that toy is hot selling. Okay, that toy is hot selling. And if you are owning a toy shop or just a kiosk at the roadside whereby you have a lot of pedestrian traffic, definitely you can sell this thing and a lot of people are going to buy it. But the question is, imagine today you still have that piece of toy in your inventory. What are you going to do it? All right. So the best thing to do is actually when you kind of reckon that the trend of that toy has already coming to a decline, you have to start long it, sell at a cheaper price, or just to recoup your cost. Okay, so this is what I call a business standpoint. You think like a businessman, right? So professional traders that think from a business perspective, right? They think from a business perspective. So, okay, which one is better? Okay, now we know that we have to think from a business perspective. The next thing, which one is better? Scalable or non-scalable business? So type in the chat box. If scalable, type S. If non-scalable, type N. Okay, which one is more, which one is better in your opinion? Is it a scalable business or non-scalable business? Right? Let me know your opinion and type it in the chat box below. Scalable business or non-scalable business? Right. Something hanging. Okay. All right. So started to see the chat coming up. Okay, scalable. So definitely scalable is the way to go. This is not a hard decision to be made. This is not a hard question. Now, let me just share with you one problem with most people. Okay, with most people. We all start somewhere. We all start somewhere with 500 ringgit, 1,000, 2,000, 5,000, 10,000. Now, when you're at a somewhat restricted capital amount, what we would do, okay, what we will do is actually, for example, you only have like 1,000, 2,000 ringgit or 5,000 ringgit. What you would do is most probably just get into one stock. Okay, just get into one stock. And that stock would represent your entire portfolio. Okay, because we are restricted by the capital that we have. So how many of you are in this stage, or you can resonate with this, whereby your capital is being restricted and you can only enter one stock? If this resonates to you, can you please type 1 in the chat box? Type 1 in the chat box. Okay, so this is a situation everyone has been there. Okay, now of course we learn somewhere, we start somewhere, which is always great. But there is one thing that we need to think forward. One day we will have a bigger portfolio. One day you might gain some confidence. Okay, one day you might be a better trader overall. So when you add more capital from 10,000 to 20,000, maybe your boss gives you a really good bonus, you add another 20,000, and your portfolio suddenly becomes like 40,000, 50,000. I think it is not a wise decision to use that 50,000 ringgit, for example, to enter into just one stock. That would sound like gambling. Okay. And how many of you agree with this? Okay. That would sound like gambling. If you agree with this, type agree. Okay. Now, of course, when we only have 1,000, 2,000, 5,000, buying to one stock is not a problem. That would actually sharpen our skill when it comes to picking stocks, stock selection. Okay. But when our capital grows bigger, it wouldn't be wise to put all the money into just one counter. Everybody would agree with that. I believe most people would agree with this. Okay, it sounds like gambling. But the next question arises is always, yes, I have 50,000, I have 100,000 to work with right now. I want to enter this stock. I want to enter that stock. Okay, I want to diversify. I see 3 opportunities. Okay, the next question is always, how much to buy? Am I going to divide equally, or is there any other better ways of doing it? So this is often the case that we want to deal with. And professional traders deal with these problems in a professional way. All right. So that's the thing that we will be talking about tonight. So investing or trading also have to be scalable. However, many retailers never put this into perspective. We all understand that if we always buy stocks, okay, with all the money that we have, that is not scalable. Even if you have the confidence to trade, but somehow people will definitely screw up. I give you an example that a lot of people will be able to understand. You know that there are a lot of people who promote Forex trading out there because it's a low entry kind of instrument that people can get in with $100 or $200 or $300. Now, it's easy to just enter one trade with the $300 that you have, because if anything were to happen, either you burn the $300, or with any losses that you have, you can, just top up anytime. And that's the problem. When like $100, $200 they put in, they somewhat get the idea how to trade, but when they put more money into it, that's when people start screwing up. Okay, so there must be a way that can allow you to scale comfortably. So successful scalable business rely on what we call system, which consists of a series of standard operating procedures, which is SOP. Now, professional portfolio managers also have a similar system that guides and grows your portfolios. So this webinar is designed in a way I want to introduce you how professionals manage and handle risk, and how people deal with risk differently. Now, a lot of people most traders out there are educated enough to know that we need to have a stop loss for our stocks, okay, for our trades. In the event that things go against us, which happened very often this year, I believe, okay, we at least have a stop loss to protect our capital. But in order to up your game, okay, in order to up your game, you need to know how professional manage and handle risk, right? So to understand risk, there is one concept that I want to share with you is what we call the 3R of risk. So risk, there are 3R. So there are three components of risk. The first is what we call, okay, let me just start with, okay, rate of winning. Okay, rate of winning. So this is what I call the risk matrix. Okay, and your results, your return is much tied up with this thing. So the first is rate of winning. So rate of winning is winning rate. Everybody understands. It's a distribution between winning trades and losing trades. So how much is your winning rate during this kind of market situation? Now, second is the risk reward ratio. That's the amount of risk versus the reward obtained on average. And third is the risk per trade, which is the amount of portfolio drawdown for every losing trade. And this is the particular one that I want to talk about very in detail, very in depth tonight. Because risk reward ratio, you all have an idea how, you, based on your own trades, how's your risk reward look like? And rate of winning, how does it look like for your own? I want to talk about risk per trade. Okay, now the next concept that I want to introduce you is the concept of R multiple. So basically, every time professional traders enter trades, the risk is somewhat being quantified, okay? And is what we call the concept of R multiple. So professional traders look into both risk and reward on every single trade. And high risk does not equal to high return, okay? Now, how much you make is not the most important thing, okay? How much you risk to make the return is the key thing. All right. So, for example, a trade that risks 10% to make 30% is better than a trade compared to another trade which risks 50% to make 100%, because the former risks 1 to make 3, while the later risks 1 to make 2. So the first one, because the risk reward is 1 to 3, so you make 3 times of what you risk. Whereas the second one, you risk, you make 2 times of what you risk. So, in other words, the first trade, your return is 3R. The second trade, your return is 2R. This is how we quantify risk, right? So, I want to give you a more, just to illustrate with some numbers. So, R stands for risk per trade in this case. So, example, you have a stock at 10 ringgit. Your stop loss is 9 ringgit. Okay. So your risk, or R, which is 1 unit of risk, equals to $1 per share, 1 ringgit per share, or 10%. Okay, or 10%. Right. So whichever you want to mention, say. Okay. So now, first scenario, if you cut loss at 9 ringgit, you have 1 R of loss. You have 1 R of loss. If you take profit at 11 ringgit, you have 1 R of reward, because that's what you risk. If you take profit at 13 ringgit, you have 3R rewards. And if you take profit at 15 ringgit, you have 5R reward. So if you understand this part, can you please type R in the chat box? Okay, if you understand this part, you are following me so far, type R. So thinking about the risk reward of your stocks that you are taking is very important. Okay. Now, why a lot of penny stocks trader, okay, or contra players in the market sort of like cannot fail to make things over the long run is because, first, they don't have a concept of risk per trade for sure. The second is the risk reward ratio. And now I always see people, contra players or penny stock players, they fall into a problem that they might not realize the impact. Okay. For example, there is a 5-cent stocks. Their stop loss is 4 cents and the take profit is 6 cents. Now, it doesn't sound like any problem because you have risk reward of 1 to 1. Okay. It doesn't sound like a problem, but it is actually a little bit of problem when your rate of winning starts messing up. Okay, because theoretically, mathematically, if your risk reward is 1-to-1, okay, is 1-to-1, then you need a 50% winning rate in order to break even. So, in the world of penny stocks, things always happen in a way that, okay, you buy the stock at 5 cents, at 4 cents. If things were to be very bad, you probably have to cut loss at 3.5 cents. Okay, so your risk is larger than what you have predetermined, and by a whole lot. Okay, so that would be one of problem. And when you take profit, okay, it depends on the way that person take profit. So once you mess up the winning rate, okay, this tree is like they're holding hand together. Okay, the higher your risk reward ratio, okay, then you have a less reliance on the rate of winning. Okay, so this one I think Malaysia trader kind of neglect a lot of time. Okay, so I don't know what's your preference of trading shares. Okay, maybe you let me know. Do you like to trade penny stocks, or do you like to trade those are small to mid cap, or you like to trade those big caps or blue chip? Okay, let me know in the chat box. Let's share with everyone, because one thing that I personally realize, and the root of the problem is always the risk reward and the winning rate. Okay, that many contra players kind of like cannot find the balance. Okay, so after understanding the concept of R multiples, the next thing that we want to find out is how can you manage your own portfolio like a fund manager. Okay, like a fund manager. So there's a concept that I want to introduce you, is what I call position sizing. So position sizing is knowing how much to buy. Now, I just want to ask you guys, okay, do you always have a problem of when you want to buy one stock, you don't know how much to buy? You know that you cannot use all money to buy one stock, okay, but you don't know how much to buy. You always have this problem. You want to diversify, okay, you know that you have to buy a couple of stocks to diversify the risk, but you don't know how much to buy. If this is your problems, can you please type me in the chat box? Me, M-E. Okay, so position sizing solves the problem or the question of how much to buy. Okay, how much to buy. So position sizing refers to the size of a position within the portfolio, or the amount that a trader is going to trade, given the risk per trade and the portfolio size. Okay, in layman's term, position sizing means how much to buy. So position sizing is an important risk management technique used by portfolio managers and professional traders, as it controls the risk exposure for the portfolio. Okay, so here's the formula. You might want to write it down. Okay, the formula is this: your position size equals to the amount of risk divided by amount of maximum loss. So your amount of risk refers to your net liquidation or your portfolio value times maximum risk per trade, divide by your stock, okay, that stock that you are thinking about to enter, the entry price minus the stop loss. Right, so every time we want to buy into a stock, this is the formula that we run through. So maybe I give you 15 seconds to write this down, or at least snap a photo. Okay, later I will show you some example and how this actually works. All right. Okay. So let me give you an example. So Mr. A has a portfolio value at 100,000 based on net liquidation. His risk per trade for this portfolio is 1%. Now, let me explain what is risk per trade. 1% risk per trade refers to every time I enter a stock, my entire portfolio is exposed to 1% risk. Meaning that if the stock that I enter were to hit stop loss, then my portfolio drawdown would be 1%. So one loss, 1%, two loss, 2%, three loss, 3% in this case. Okay. And also, just now we talked about risk multiple. Now, if my risk per trade for this portfolio is 1%, okay, so every stop loss, every unit of risk is 1%. So if there is a trade that makes me 3R, then my portfolio will go up by 3%. Okay, so now Mr. A wanted to take a position on stock AAA. The entry and predetermined stop loss are as follow. So entry is 5 ringgit and stop loss is 4 ringgit 50 cent. Okay, this is the individual stop loss. So based on the position sizing, how many units of stock AAA Mr. A should buy? Okay, so what you do is this formula. So your position sizing, portfolio size times risk per trade, divide by entry minus stop loss. So 100,000 is the portfolio size times 1% risk per trade, divide by entry 5 ringgit minus stop loss 450. So 1,000 ringgit is the maximum loss that this portfolio will suffer if the position were to hit stop loss. Okay, so if you work the math out, then it'll be 2,000 units. Okay, will be 2,000 units. So basically, how this work is like this. If he were to hit stop loss, okay, and sell the 2,000 shares, okay, 2,000 shares, okay, let me just calculate this. So first, he would buy the stock at 5 ringgit each times 2,000 shares. So it would take up 10,000 ringgit for this position. Okay, 10,000 ringgit to buy this position, buy into this stock AAA. Now, in the event that if you were to hit stop loss, he would sell the stock at 450 times 2,000 units that he has, then it will end up with 9,000 ringgit. So the loss is exactly 1,000. Of course, it would have some, disparity because we have like broker fee. Okay, sometimes you might be selling at, 449, 448, okay, things like that. But you are close to 1%. So meaning that every time if you hit a stop loss, it will lose about 1%. Okay, and 1% of 100,000 is controllable. Okay, this kind of risk is very controllable. Okay, now let's have another example. Okay, so this is the explanation. So Mr. A will enter 2,000 units of stocks AAA at 5 ringgit, using up 10,000 ringgit of his buying power. So should stock AAA drop to his predetermined stop loss of 450, he would then sell the 2,000 units of stock AAA and get back 9K. Okay, the loss would be 1,000 before fee, and his portfolio value would drop by 1%. And this is the predetermined risk per trade. Now, if stock AAA go up and Mr. A sells at 6 ringgit 50 cent, for example, he would then sell his 2,000 units of stock AAA at 6 ringgit 50 cent and get back 13,000, which is a 3,000 ringgit before fee. So his portfolio would grow by 3% in value. In this case, the return is 3R. Here, the return is 3R. As the predetermined risk per trade is 1%, and right now Mr. A grows his portfolio by 3% as a result of this stock, his risk reward ratio is 1 to 3, as he made 3R from this trade. Okay, this is a concept of risk multiple. Okay, this is a concept of risk multiple. So just to share with you, okay, all these things, okay, of course, if you want to go more details, we can go more details because you want to project, okay, a portfolio return by your average winning rate and risk reward, then you can roughly calculate. Okay, so meaning that if you want to grow your portfolio by 20% and your risk per trade is 1%, then you need 20R in a year to get a 20% annual return. Okay, this is basically how fund managers do things. Okay, like your unit trust. How are they going to know how much they want to expose one stock to? Okay, Of course, they are not going to use 1% risk per trade, and they are always buying in batches. But the basic concept, the concept behind every purchase is they quantify risk in a certain way. Okay, so for individual portfolio managers like us, then if you are managing your own portfolio, you are a portfolio manager because you manage your portfolio. Okay, so it doesn't mean that you manage for other people. You manage your own money in a way like a portfolio. You are your own portfolio manager. Okay, so with this kind of risk management, you can trade any size, be it your portfolio is 50,000, 100,000, or 2 million. Doesn't matter. Okay, it doesn't matter. All right. So some of you might wonder, if my portfolio only 10K, can I use this? Okay. How many of you are wondering this? How many of you are wondering this? Is this your question? If yes, then type me. Yeah, there are calculators out there. Okay. Okay. So, okay, let me just share with you very quickly. If your portfolio size is small, or maybe in Malaysian, we call it alang-alang. Okay, so for example, your portfolio is 10K. Okay, 10K. So of course, 10K, you're going to buy a stock. Let's say the entry is 5. Okay, your stop loss is 450. Okay, 450. So my suggestion would be you raise your risk per trade. Okay, you raise your risk per trade, because if you're to follow 1%, okay, if you were to follow 1%, then you will end up buying only 1,000 ringgit worth of the share, and you know that the which is you slash 10 from the previous example. So what you can do is you use 3%. Okay, you use 3%, and you still get a decently diversified portfolio. So your 10,000 times 3% risk per trade, divide by your entry minus stop loss. Okay, so when you do the math, it will be 10K times 3% would be 300. Okay, divide by 50 cents. Okay, let me just double confirm with calculator. Okay, 10,000 times 3% divide, okay, 600 units. So 600 units of this share that worth $5, you're going to use 3,000 out of okay your 10K portfolio. So in the event that your stock hits stop loss, your risk will be, your capital at risk would be 300 ringgit. All right, so that's how you can start doing things. Okay, that's how you can start doing things. And just to share with you one more tip. Okay, just to share with you one more tip. All right, so do you guys want one more tips? Okay, if you want, type 1. Okay. Okay, great. Okay, now, do you know that we have a margin account? Okay, I'm talking about margin account, not your contra account whereby you have a T+2 limitation. Okay, now, if you want to use margin account in a safe manner, you probably heard a lot of tragic stories whereby people use margin to buy one stock, and then they just whack one stock use the margin to whack one stock, and then after that stock have some stories, and the stock keep going down, and people just like lost a lot of money, and some even try to suicide. Okay, you hear a lot of these kind of problems, but just to share with you, if this position, you were using like 3K to buy, okay, 3K to buy into, with a 10,000 portfolio, with maybe this kind of 10% stop loss, because this one is 10% stop loss, okay? You enter at 5, stop loss 450, 10% stop loss setup. you will be using 3,000 ringgit to buy one counter. You would max out at 3 counters. Are you with me? You do know what I'm talking about. If you understand type 3, meaning that your 10K, you will run out of capital at 3% risk per trade. Okay, you can only buy 3 stocks. Okay, because if you want to buy the 4th stocks, you will run out of capital. Okay, so after 3 stocks, then your capital at risk would be 300 times 3, which is 900. Okay, now of course, when your capital is small, you need to do a lot of heavy lifting. That's why people with smaller capital, we tend to take more risk. Okay, I believe everyone have been there, even if you have a big portfolio today. Now, how do you solve the problem of capital not enough? Let's say this portfolio you want to buy, this 10K portfolio, you want to buy into the 4th stocks. Okay, the solution is to use margin account in a way that you know how much risk you're exposed to. So for the 4th stocks, you are also using 10K as your calculation. Remember, the formula is net liquidation times risk per trade, not your buying power. Because when you put 10K into your account, your buying power will be like 25K, okay, or 15K, depending on what package you have. Okay, so don't use 15K or 25K. Use 10K. That's your net liquidation. So 10K times 3%, they have another stock. Then you probably will use up another 3,000, okay, to buy another stock. And by taking margin to buy the 4th stocks, you will only expose yourself with 4 stocks with a total of 1,200 of risk. Okay, so this is how you can use leverage without high risk, without the kind of damage that a lot of people will get. Now, of course, this is granted your risk reward ratio is healthy and your winning rate is healthy. You know that you have the edge in the market. You just don't have the capital to play to up your game. All right. This is the way how I have been using margin back in the days, okay, to expand my portfolio quickly without bearing a lot of leverage risk. Okay, so if you learn something, can you please type yes in the chat box? Okay, if you learn something, type yes in the chat box. So this is how you can actually use margin safely without stupid level of damage, because the risk is predetermined. Okay, you know that in that situation, the maximum you lost is 1.2K, maybe 1.3K, because sometimes we got execution, inaccuracy. All right, so that's how I have been, advocating my students to take up, to trade with margin, but with the amount of risk that you still predetermine or you still understand. Okay, not like using margin and max out your margin and you don't know how much you're risking. Okay, so the next thing is just to share a bit about position adding. So when not to add and when to add position. So one mistake that many retailers intuitively, sometimes by intention, is averaging down when the stock go against them. Now, given that capital is finite and limited, especially for retailers, averaging down is never a good idea, because adding position on a losing stock means more of your already limited capital will be stuck in a losing stocks. Okay, so probability wise, stocks that are going down will carry higher probability to go down. Don't say that the stock has value or things like that. Sometimes you just don't know how low a stock can potentially go. Okay, so adding positions and pyramiding when a stock is going up is the general practice. So what professional traders do a lot of time, and it amazed me when I first time I learned from my mentor. Professional traders, they actually add more positions along the way. Of course, they have to recalculate the risk, but the general idea is you add a little bit more. Last time you buy 10 lots, maybe when the price go up by 10%, you buy 5 lots. okay, because the trend usually continues. And pay close attention to your new average cost if you were to, add positions, okay? And you have to move your trailing stop. So make sure when your trailing stop is hit, you will not end up with loss. So what is trailing stop? Trailing stop means this. If you buy a stock, for example, at $5 here, okay, and your stop loss is maybe 450. Okay, your stop loss is wait. Maybe I use this. Okay. What is trailing stop? So for example, if you buy a stock at $5, your stop loss is 450. So when the stock go up, okay, to maybe $6 already, okay, impossible your stop loss will still be 450. So what you do is you move up the stop loss. You move up, maybe become 550. Okay. So the thing is, when the stock going up and up and up, you keep moving your stop loss, moving your stop loss, moving your stop loss, moving your stop loss upward until one day it hit your stop loss. Okay. Then this is what we call a trailing stop hit. All right. So pay close attention to your new average cost after you add positions and your trailing stop. So make sure when your trailing stop is hit, you would not end up with loss. This is the key thing that you need to be careful when you add position. All right. So reduce position. When to reduce position? The objective of reducing position is always to minimize risk at this highly volatile and uncertain situation. All right. So you reduce risk when you don't feel confident about the crazy volatility or the market. Okay. So reduce position when the stock gap down too much. It's usually not a good sign. Okay. And the thing is, gap down is like that stock gap down, not the entire market is suffering. Sometimes when the entire market is like, gapping down because previous day the US market was terrible, then it's still fine. You have to be careful when other stocks are doing okay and that stock gap down. Okay. So that is when you might want to reduce your position a little bit. Reduce position when the market or the sector suffer from unusual volatility. Okay. Suddenly yesterday up 8%, today dropped 7%. This one you also need to be very careful. Okay. You are emotionally not comfortable with the movement of the stock, or the stock has been going sideways or non-performing for a period of time. This is what I call a time stop, meaning that you stop yourself out because of non-performance. Okay, so that you can use your capital in some stocks that might be more performing. Okay, that might generate at least some income, at least some movement for you to work with. All right. So last, I'm going to show you some examples on how you can use this in your practice. Okay. So how to position trade by following trend. Okay, so this is the first example. So this is tax cam. So you know that previously this going up and up and up and up and up. Okay, then go down. And this was still in an uptrend, and there is a midterm correction here. Then the stock turns up again. So when the stock turns up, it go up, it forms a higher high, higher low, higher high, higher low. And you see that the EMAs, in this case, is the 20 and the 50, I believe. Yeah, 2050, it crossed to form an uptrend formation, and then it has a breakout. Okay, it has a breakout. So actually, when it forms the trend, okay, you can start, I like to buy a rebound. Okay, so when I see higher high, higher low, higher high, higher low, higher high, higher low, when it rebound, when it has a price action, I will buy into the stock. So you can buy when it rebounds, okay, buy at rebound, and then you set a stop loss below the previous swing low. So in this case, you can see that the risk is 9.77%. Okay, the risk is 9.77%, and the entry is at 307. Okay, 307. So how can you calculate this? Portfolio size, for example, 100,000, risk per trade 1%. So the stock tax cam, your entry 307, stop loss 277, which is below the swing low. Okay, And then the position size work out to be like this. So 3333 shares, you know that you wouldn't go and buy the 33 shares at the odd lot market. Okay, so you use 3,300. Okay, sorry, you buy 3.3 full lots, okay, or 33 mini lot. Okay. Personally, I call one lot 1,000 shares. Okay, 100 shares to me is mini lot. So in this case, to me, is 3.3 lots, okay, of tax cam. All right, so you can see that risk per trade is close to 1,000 because it's 1% of 100K, and profit at 3.69, which is about 2,000, which is about 2R. Okay, so this is how you can do it. Right? So, of course, how to take profit. Okay, this one, it depends on your own strategy. Okay, this one, of course, we know that it has already gotten down, but if you enter during this period of time, it will still make money. Okay, it will still at least be a green one, just that the risk reward might be off a little bit. Okay, so the next stock that I want to show you is Hanlen. Okay, so this stock has been really rocking it. Okay, so you can see that previously this stock went up and then it consolidated into a sideway and then boom, breakout. This is another way that you can enter stocks. Now, just share with you the way I enter stocks. I'm a trend follower. I look for stocks that have been in an uptrend, then they consolidate into a sideway or they have some kind of pullbacks or correction when they resume the trend. So the key here is I want to find trend resuming. Okay, I want to see the trend continues. So either I find setup like it has a higher high, higher low, higher high, higher low, and I buy on the rebound, or I find breakout like this, whereby the stock has been consolidating, okay, consolidating and then went up, then I can look into buying. Now, in this case, if you miss the breakout, what you can do is you wait until you retrace back to this area. You can see that previous resistance turned into a support, and here is also a dynamic support at the orange moving average right over there. So you can seek for entry when it starts rebounding. So in this case, enter at 139, stop loss below the previous swing low and also below the EMA 20 in this case. So the stop loss is 9.35%. And just to share with you my personal practice, I don't take stop loss larger than 10%. Okay, so you could probably also know that I don't trade penny stocks, because penny stocks anyhow, okay, the stop loss can be larger than 10%. So stocks above like 50, 60 cents, I might consider, but not always the stocks that the price range that I focus on. I usually prefer stocks above at least 1 ringgit or at least above 2 ringgit. Of course, I understand in the current market right now, everything is in a mess. Okay, so sometimes we get to trade what are being presented in front of us. Okay, so this is another example, right? So, okay, portfolio size, 100,000, risk per trade, 1%. So the stock is Hanlen, okay? Entry 139, stop loss 126, as shown in the chart just now. And position size is 100,000 times 1%. Okay, so in this case, 139 minus 1.26. Okay, entry minus stop loss. So 7,692 shares, we run down. We round off, basically. We don't round up. Okay, so we buy 7.6 lots. In this case, we spend around 10,000, 10.5K. So profit at 1.65. If you were to take profit there, it will be 1.9K, which is slightly under 2R, despite the risk reward is slightly above 1.1 to 2 due to the position size rounding off. So you don't always get the like exactly 1%, but you are almost there. At least you quantify the risk. You know roughly what kind of what level of risk you are probably dealing with. Okay, you are probably dealing with. All right, so that is the way that we calculate position size. So next thing that I want to show you is not all the time our stop loss is 9 or 10%. Okay, not all the time our stop loss is 9 to 10%. Sometimes the ideal stop loss can be smaller. So I want to show you what could happen when you have a smaller stop loss. So in this case, we have AMMB. Okay, okay. So you can see that it has a rebound, and the previous swing low is technically here, but I can put even way below to the previous swing low right here. Okay, right here. So the risk is still 6.62%. Now, this is the type of stocks that, those banking stocks. Okay, even look at stocks like this, or like stocks like Arfin, okay, it has been like going up. The trend very nice, but you go and measure it, it's like I hold for like 3-4 months, only 10%. Okay. Yes, they are kind of slow movement stocks. Okay. But with this, slow movement doesn't mean that your return is going to be slow. Okay. Because there is one thing here. When you have a smaller stop loss, okay, let's say our portfolio size is 100,000. Your risk per trade is 1%. Okay. So your stock, M-Bank, okay, entry, 4 ringgit 5 cents, stop loss 378. So your stop loss is like about 6% only. So in this case, you can see 6%, 6.62. Okay, 6.62. And then the position size, you will actually buy 3.7 lot, which you are using a slightly more capital to buy. Okay, why? Because of the formula, it kind of like, because you quantify risk, this is a low risk trade. The risk is lower for this trade. So by exposing equally to the risk, okay, exposing the equal risk to compared to other trades, okay, this stock will naturally, okay, being bought in a larger position. Okay, in a larger position. Let me just pull out my charts. Okay. Okay. And let me just show you maybe a little bit of example. Okay. Now, sometimes boring stocks, okay, boring stocks. Let me just, okay. Now, a lot of people see this as a boring stock, okay, because it's bang. Okay. So if you were to buy here, because again, this is a higher low, okay, this one is a higher high. So you might want to buy right here. You buy right here. So if you were to buy right here, assuming that you take profit today, okay, assuming that you take profit today, you buy right this breakout, okay, assuming you take profit today and your risk is below here. So you can see that the risk, maybe I can put even below here. The risk is 5%. Okay, I put below this swing low. The risk is 5%, which is very tiny. And this kind of stock is the kind of, boring stocks whereby you hold 1 month only probably make less than 10%. But because this stock is naturally lower risk, when you apply the portfolio sizing formula, 5% risk, it will automatically let you buy more. And you can see that in this case, the risk reward is 1 to 1.26. So you can also grow your portfolio by 1.26 with these stocks. Okay, 1.26 compared to maybe some other higher risk. Like for example, okay, let's just use TechScam. For example, this one. Okay, the risk is definitely higher, but how do the portfolio sizing sort of like ease off, okay, the risk a little bit? You see this one? Even if you sell off when it started shoot up and drop, meaning that it does not have the power or momentum to break this high, your risk reward is like 1 to 1 point, probably 1.5 if you can sell a little bit higher. So volatile stock, you buy less naturally. Okay, volatile stock usually associate with larger stop loss. A larger stop loss, naturally, after the calculation, you will buy less. So quote unquote, more boring stocks, you'll buy more. Okay, so high risk, low risk. A lot of time, if you are in a proper portfolio, management situation, it doesn't really matter. Okay, what matters is the risk per trade. Okay, that you have set, and also how many R's that you have made. Okay, how many R's that you have made. So this one is the recent example that you can make a little bit more. Okay, so you can see that this one is the kind of like this one wash people out, but it has been steady uptrend. Retrace, go up, come down, rebound. You can buy, and you buy here, stop loss below it, and up to today, you have a risk reward of 4.71. So this kind of trade is like a jackpot trade because one stock, okay, is no, the stop loss is below here. Okay, about 3.3 risk reward. So this stock would grow your portfolio by 3%. It will grow your portfolio by 3%. Okay, so sometimes, like, back in 2020, 2021, those glove stocks, technology stocks, those stocks probably grow a portfolio. One stock, if you can make 8R, 10R, it will grow a portfolio by 8%, 10%, and things along like this. All right, so that would be, I believe that would be all for tonight. Okay, I hope that you at least you have expanded your knowledge, okay, towards how you can actually manage risk in another way. So how many of you gain a different perspective tonight on trading, portfolio management, and risk management? Can you please type me in the chat box? Type me in the chat box. Okay, so generally, okay, this is just the how. Okay, this is to introduce you to the world of professional portfolio management. All right, so that will be all from me. All right, so I'll hand over the sessions back to Shane.
All right, thank you so much, Jin Hao, for sharing with us when precision trading meets proper portfolio management. So I think we have gained a lot of knowledge in position sizing and so on. So if you have any questions that you want to ask Jin Hao in relation to the topic that he just presented, please write your questions in the Q&A box here, not the chat box, okay, in the Q&A box here, so we can better manage your Q&A. So the first question is by Zhixian. Can we do position sizing with low capital since the cost of trading will be quite high?
Okay, so I don't know how low is low. Okay, I don't know how low is low, but okay, to me, anything less than maybe 8,000 or anything less than 10,000, I would say that you got no choice. Okay, when our capital is small, you need to do the heavy lifting, meaning that you just trade with one or two stocks, and if you have a loss, then you have to top up yourself and grow from there. Okay, but after 10,000, I would say that you can start position sizing, okay, with 3% risk per trade. Okay, 3% risk per trade. And I want you guys to understand another thing as well. Learning position sizing will definitely throttle down your return if you have been buying and selling stocks without position sizing. Okay, but the thing about position sizing is you quantify the risk and you know exactly how much risk you are liable to. Okay, and you can get a better idea on your trading strategies overall. Okay, so of course it cannot be compared to one person who trade, buy 100,000 worth of top glove back in early 2020. It cannot compare in this way. Okay, of course, that would be more profitable than managing a proper portfolio, like with position sizing and things like this. So just to understand that you are here to do things in a very systematic way. Okay.
All right. So the next question is my Mark Chan. How do you draw stop loss and profit target with a certain percentage in your trading view?
This one, you just press this, okay, the icon here, then you tick long position. You click, and then you just click anyway, and you adjust the line like usual. Okay. This one is just to, calculate a little bit here and there only. So not very important. You can do manual calculate also, but this one is, sometimes it's better to show you guys the situation easier.
All right. The next question is by Kelly. What is your setting for the 3 simple moving average lines?
Okay, I don't use SMA, I use EMA. So actually, I know that every time I show this, people will ask, but just to let you know, this one is 20, 50, and 200, and it doesn't really matter much because the key of using EMAs or SMAs is you need one line to represent the short term, one line to represent the midterm, and one line to represent the long term. Okay, so as long as you have these 3 lines, okay, whatever you want to use, you want to use 10, you use 30, you want to use like 60, you would get the same idea. Okay, you will get the same. It's like if you look at Power Root right now, whatever EMAs or SMA you use, it will show you that this stock is in an uptrend. Okay, so at least to me, I use 20, 50, 200. But just to let you know that if you want to catch rebound on certain moving average, just understand that you need to do back testing. Not all stocks hit 20 and rebound. Sometimes some stocks hit 30 and rebound. Okay, so this is something that you need to know. So if you want to be that accurate, you still need to do back testing. Okay, like because some stocks, they react to different lines. All right.
Okay. The next question is by Zixian. For trailing stop, do we set a swing low or moving average 20 or any other ways that we can set trailing stop?
Okay, let me just show you one example. Okay, it's very simple. You go trading view, okay, and you search for super trend. Okay, you search for super trend. Now, I don't buy with super trend, but you can definitely use super trend as a trailing stop. Okay, so how do I use this? I set this level, okay, this lower band, okay, as a stop, a trailing stop. Okay, of course, you can do in a few ways. If you have a larger portfolio, you can sell half if it hit this level, and the other half you sell when it turns red. Okay, you sell the next day, things like that. Okay, but this is a guideline. Okay, this is a guideline. If you are you look at Hanlon, you can know that this for long-term trend following, this would work. But of course, sometimes if you feel like using like EMA 20, you can also do that. Okay, some people may use things like 5 cross 20, things like that. Okay, whatever works for you. But as a trend follower, I use super trend. Okay, I just show you. Okay, previously like the glove. Okay, how do I exit? I use this one. Okay, I use this one. So once it turned red, okay, the next turn red, first day it turns red, then the next day I sell. So the next day I sell at 16 plus. Okay, although I forego quite a lot of profit, but I bought way earlier. Okay, especially like this kind of like high volatility stocks, using super trend can be a good guidance because super trend factor in volatility, because the calculation of it uses ATR. Okay, it uses ATR. So yeah, that's one of the ways. Super trend. Another one you could use like general, and you can use EMA 20. And of course, any big drops that you don't feel comfortable, you reduce your position. All right. Okay.
All right. Thank you so much, Jeen Hao. The next question is asked by Uya. Can you show us how do we put risk to reward ratio using trading view?
I think it's the one that they are referring to. This one. Is it?
Okay, I think we wait for his clarification.
Yeah.
Okay. These are Asked by two different person.
Yeah, at two different places.
The next question is asked by Ahmad Nazri. So in 2020, we know that the glove sectors was in a super bull run. So in this year, which sector do you think has potentials, for us
Potential.
to look at?
First thing, to me, 2020, the best performing sector is not even glove. Okay, it's not even glove. Actually, tech has a way better rally than glove. Okay, if you look at stocks like MPI, okay, if you look at stocks like MPI, the rally is even better. You can see beginning after the COVID crash, it go up and up and up and up until beginning of this year. So first thing, to me, trend-wise, glove is not even the best. It is just one short push for a couple of months. Okay, trend-wise, tech was the strongest. Okay, now 2022, to be honest, you survive first. Okay. The thing that we see is, big money. Okay. I think I did a sessions with Busa as well. Okay. It's like in Busa, how can you have a more better profit? What's the sort of like the rhythm of Busa market? When traders make a lot of money, okay, during periods whereby there is a theme. For example, many, many years ago, when ringgit was weak, I'm not saying that ringgit is weak right now and then you should go and buy. Disclaimer, not this case and not right now. Okay. Do you remember that last time our dear PM, okay, because of something, some scandal, some big project, okay, and then ringgit depreciated. And during that time, there is one team called export sectors. And then that's when the glove was up, semiconductor was up, packaging stocks was up because they are doing exports. Okay, so you will realize that usually big money can be made when there is a team. Like glove, why glove can make big money? Because there is a team. Why tech can make big money? Because there is a team, or at least the entire sector move together. And right now we are in a situation whereby no sectors is moving. No sector is moving. You have a clusters of stocks that are going up. Okay. I think strong stocks in Malaysia right now is like maybe just 10 stocks like Texcam, Chin Hin, Hex Industry, maybe like some are being speculated, of course, again, like Hanlen, like Fiamma, CFM. You have clusters of stocks and they are not even a team. Okay. So in this kind of market, aim for survival first. And then to me, to be honest, I only trade with half of my portfolio right now in Malaysia. When there is no team, to me, there is no point to go aggressive in the market. And this is at least from my experience. I hope that I answered Ahmed's question.
All right. So thank you so much, Jin Hao, for
Better
sharing
to be
your 2
safe
cents.
right now. We all know that the market is not
okay.
good.
Survive 2022.
Mm.
Okay. So we can thrive in the years after.
Yeah.
Lily would like to ask the next question. How do you justify stop loss percentage for different stocks?
Okay, I think this is a good question. Okay, let's look. Let's find one stock. Okay. Now, assuming you want to buy this stock. Okay. This stock stop loss a bit too high also. Let me see if I have a better stock. Okay. Assuming you want to buy this stock. Okay. So let's say if the stock were to turn up, okay, you want to buy. So let me ask you, at which point you don't want to continue hold this stock? It could be when it go down like this. Okay. So what we do is we set the stop loss at a level whereby the chart turns sour. or you think that it is not worth holding. So usually, from a technical perspective, we would set below the previous swing low. All right. So if I were to buy here, let's say if I were to buy here, I will set a stop loss below this level. It can be below the EMAs or below the previous swing low, as long as I set it at a place whereby it doesn't worth holding. That would be the way we save, we set stop loss. Okay. I give you an example again. Okay. So let's say for this one, for example, if you want to, there you might think that there's a rebound. So if you want to buy here, of course, if it breaks this swing low, then boom, the stop might not be great. So I set the stop loss based on this. Okay. If it breaks below this swing low, then I cut loss. Okay. Because there is no point holding anymore. So in this case, it'll be at one ringgit 2 cents, somewhere around there. Okay. Right.
All right. Thank you so much, Jin Hao. So the next question is, what would be the parameter setting for the super trend?
Original setting. So here you go. ATR 10, multiplier 3.
Okay. The next question is by Ang. Your swing low loss is the wick or the horizontal support?
Okay, usually I consider the wick. Okay, let's say if you want me to be very exact, okay, this is the swing low. Okay, if I consider this as a wave, go up, and then something like this. If I consider this wick, I would put below this wick. I consider the shadow as well. Okay, so I will put below it. So how far below? You can use ATR as a guideline. How volatile the stock is, then it gives you an idea. Like this one is a 1.03. Okay, then you can have an idea how low below it you want to put. So of course, for more volatile stocks, you want to leave more cushion below it. Right. Okay.
All right. Thank you so much, Jin Hao. Now, what would be your idea or advice that if you have bought the stocks and they keep getting lower and lower, should we cut loss?
Okay. First thing, are you an investor or a trader, or you wanted to trade then suddenly become investor? I think this one is the thing that you have to sort out. Okay. If you are a trader, okay, if that stock, you buy it, the intention is trading, remember that you always have to stick with the stop loss. Then if you mess up this trade, then I would say that you just have to make a decision whether or not you want to cut it and then learn the proper way, do it right the next time, treat it as a lesson or what. Or if this is a money that you don't mind, meaning that this is a money that you don't feel painful even if you don't cut, then for the next coming trades, you start doing the right thing. If it is for investing, then you want to ask yourself, what is your investment plan? Okay, if you keep buying lower and lower, because to keep collecting stocks, you need to have a certain level of understanding and confidence towards that stocks or ETF. So you might want to re-question your conviction towards that stock. All right. So I don't know your specific situation, okay, but that would be a direction for you to think about it, okay? Because I believe a lot of people initially, they actually wanted to speculate that that would be the bottom, and then they buy, and the market just keep getting lower and lower, and some people might average down, and in the end, they realize that they are just digging a deeper hole. So I don't know what situation you are in, but what I've mentioned just now might be a little bit of guideline for anyone who are stuck in a situation right now.
All right. So the next question is by Ang. Is your ATR 14 or a different number?
14. Standard 14.
Okay, it's 14.
Mm.
So the next question is by PK. How do we do persistent trading in an uncertain market like right now?
I only focus on uptrending stocks, okay, because the method that I use is trend following. Okay, so I focus on uptrending stocks, and naturally during this kind of market, the choices that you have is way less. So it doesn't really matter much. Meaning that during this kind of situation, I just have less stocks to trade compared to last year and the year before last. So that's the thing. And also, generally, when the market is weak, I don't go full position. Meaning that if you have 100,000 portfolio, perhaps you trade 50,000 only. The other 50,000 you reserve first. Or you trade half the capacity, meaning that usual time you buy 5 or 6 stocks. Maybe right now you limit yourself to only 3 stocks. Just to reduce the trading activity a little bit. And also train yourself to pick the best out of the best that you could, because choices is already quite limited. So that's the thing that that personally I do. Okay, Malaysia market right now, Bursa market right now, honestly speaking, I am really not very active with it, but it doesn't mean that I have 0 positions. Okay, just that not as active as 2020, 2021.
All right. The next question is by Prakash. Which time frame is the best for super trend?
Day.
So you look at the daily time frame now.
Daily. And generally, I only trade with daily.
Okay.
Unless some of you might want to have a more precise entry, then you might want to, enter into hourly chart.
Okay. So when we do persistent trading, right? Do we usually get in the early trend, mid trend, or late trend? If it's late trend, would it be too late?
It doesn't matter. As long as it's still up, we believe that it has higher probability to go up instead of down. So whether or not early trend or middle trend, then that one depends. You wouldn't know the trend is high when the trend ends, technically speaking.
Okay.
Yeah, so it's either during the beginning of the turnaround or it is already strong up. Because if it doesn't turn down, then you don't know where the high was. So there are different strategy, different approach, but generally we just follow the trend. Just that maybe you need to use like different kind of like indicators to determine whether or not there's an early turnaround.
If it's a downtrend and suddenly there is a breakout,
okay,
will you consider getting in an early trend?
I have a few steps. Like we want to wait this trend to establish, not just like going up for like 1 or 2 weeks, then end of the story again. So the first thing is I want to ensure it at least break 1 month high. Then I want to see the trend establish. If a stock does not break 1 month high, I don't even look at it.
Do you have like at least how many higher high and higher lows that it must establish first?
Actually, after break 1 month high, then you can be a little bit more
pay more attention.
Yeah, you can put more attention.
Even though the long-term trend could still be down, but then if they break 1 month high, you will put them in the watch list. Am I right?
Yeah. Yep. And if it break 1 month high, I don't chase in. I wait it to, go down first. If it can prove to me that it can go down and then go up, form a higher high, higher low, things like that, then I will go in again. I can show you guys some example.
Okay, sure.
Okay. Let's put some infamous stock. Right, you can see this one, the 1 month high broke here. So if you're wondering what indicator is this one is just price channel, or what we call Don Chen channel. Okay. So the upper band is 20 days. 20 days, almost 1 month. So this one break 1 month, but it go down, it did not rebound. Okay, and technically it's still downtrend. And then after that, you can see that the EMAs, they are technically still downward sloping. Okay, they are still technically downward sloping. So that's why I don't get into it. So you can see the next time it go up, come down, I might buy this rebound as an early reversal, but I won't go all out. So you can say go up, come down, go up again, boom, come down. So this might be a break-even trade. Okay, might like the stock cheated me to go in, then go out. Okay, and here you can see that the entire time we don't even look at it. So this one, it break up a bit, then boom, go down. No story. This one go up, retrace, end of the story. Go up, retrace, it got a bit, does not rebound enough for me to go in. Then after that, it goes break a new low again, then no need to see already. This one break a bit, then no story. So until now. So how does a good rebound or recovery looks like? You look at UWC. To give you guys an example, this one, okay, down, 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 we don't care. And here, go turn up, come back down, go up again, second wave. Some people enter here, but I wouldn't. Then here, you get an EMA crossover, which is another level of confirmation, things like that. So you go up, come down, and right now it is piling a sort of like a sideway, a consolidation period. So in other words, this stock to me is ready for me to go in if it shows me a good upward movement. Ideally, I want to see go up, boom, break a new high, come back down, retrace to this EMA 200, then go up. I would buy. Okay, of course, set a stop loss. Right, so this is an example of how we plot things and get ready for a trend. You can see that previously after the post-COVID, okay, post-COVID, you can see that this was the COVID crash, and then go up. Here, it started break 1 month high. Okay, you can see that break 1 month high, come back down, retrace back to EMA 20, then boom, go up. You can start buying. Why? Because EMA 20 is also sloping up already, and EMA 50 is not sloping down. So that's why you can know that this could be a good entry. Of course, you buy in maybe 1/4 or half of the position, then every wave it go up, you can add a bit, add a bit, add a bit. All right? Yep. That's all.
All right. Thank you so much, Jeen Hao, for sharing with us, how you look at trend. Yeah. So it looks like there are no more questions on my screen right now. So you may let me share my screen.
Yep, sure.
So yes, thank you so much, Jeen Hao, for sharing with us, when position trading meets proper portfolio management. All right, for those of you who haven't checked out Bursa Academy is a comprehensive one-stop e-learning platform that aims to provide investors with a continuous and holistic learning journey. It is simplified, it is user-friendly, accessible anywhere, anytime, at your own pace. So on Bursa Academy, there are a lot of investing resources that you can reference. So just visit www.bursaacademy.bursamarketplace.com or scan the QR code at the bottom right to visit Bursa Academy. Our next webinar is titled Trading Method Heikin-Ashi. So in the next webinar, we are going to discuss how do we use this type of chart called Heikin-Ashi to find trading opportunity, to find buy and sell signals. Okay, there are many types of chart, and Heikin-Ashi is one of them that smoothen out a lot of things in the market. And how to use this trading method to find opportunities. All right, so it's happening on this Friday, which is the 9th of September, 8:30 to 10 o'clock. Let me give you the registration link again. So if you want to learn about how to use Heikin-Ashi, please enroll into this webinar so we can support you and guide you in using Heikin-Ashi. All right. So with that, we would like to thank Jeen Hao, who is the Chief Master Trainer of Street Finance, to come to this Bursa webinar and share with us when position trading meets proper portfolio management. So thank you everybody for joining in this session. Hope to see you in our next webinar. Bye-bye.
Bye, everyone. See you guys.
Bye.
Follow me on social media if you want to learn more. All right, bye. Thanks, Shane.
Bye. Bye, Jeen Hao.
Bye.
Right.